Hello and welcome to this session, Institutional Crypto Trading, Derivatives and Short-Term Realities for Structured Products. I'm your moderator, Nick Wakefield, co-founder of Regulation Asia. Delighted to welcome the panelists for this discussion. Miles Binney is counsel in the Global Financial Markets practice at Clifford. He has extensive experience in fintech, particularly blockchain and crypto trading products and collateral. Welcome, Miles. Adam Farthing is Chief Risk Officer at B2C2, a trading firm in the institutional crypto markets, now majority owned by Japanese financial group SBI. Welcome, Adam.
Thanks.
Clare Weaver is an English solicitor and legal counsel within the Wholesale Digital Office at Nomura. She leads the legal and regulatory activities for Nomura's global digital asset and DLT business. Welcome, Clare.
Thanks, Nick.
And Keith Noyes is Chief Risk and Compliance Officer at Covario, a prime brokerage for digital assets. Prior to this, he was APAC Regional Director of ISDA for 12 years. Welcome, Keith. Okay, so before we dive in, as always, please feel free to ask any questions to the panelists and we will try to cover them if time allows. Okay, so I think the best way to kick off this panel session will be to get a sense of where we are now and where we've come from in relation to institutional trading of physical and derivative cryptocurrencies. Adam, perhaps you can set the scene here and give an overview of the development of the market over perhaps the last 3 or 4 years.
Yeah, sure. So I guess, if we go back 4 years ago, crypto trading was mostly about spot physical. And the main battle was generally how to manage the settlement process, where you're settling, the two assets that you're swapping are settling on two completely disconnected systems. Fiat, obviously, going through the banking system, and crypto settling on the blockchain. So in 2018, B2C2 put in its first derivative product, being a CFD. Obviously required standardized documentation and a margin process, and it enabled clients to access price risk without having to endure the hassle of settling. We released that product in Japan in 2018 and rolled it out globally over the next year. In 2020, we rolled out our lend-borrow products, primarily term deposits and secured loans. And those products, now that we have pretty liquid books, pretty large books on those, we're able to imply and maintain fairly liquid interest rate curves for basically the top 20 coins, which is what we trade. So we can, have a proper price here. We can say that the price of those coins is now a proper function of time, which is obviously a prerequisite for derivatives markets. Building on that, in 2021, we started offering liquidity in options to enable our customers to hedge volatility risks in their portfolio and also take a view on volatility itself. And in 2022, we're building out further into structured products. There's been a big demand from clients for yield enhancement this year, given the price appreciation we've seen over the last 12 to 18 months. I think, for the future, I think, the pace of innovation is just going to continue, if not accelerate from here.
Thank you, Adam. I want to kind of move on to perhaps some the important area of this space at the moment in regards to kind of the challenges that obviously institutional firms are having. Clare, you're working for a large global investment bank. You're interfacing directly with institutional clients. What are some of the challenges that you foresee, both from a client perspective and also from the bank itself, when trying to deal with interest and demand, obviously, in these crypto-related products and instruments?
Yeah, thanks, Nick. Obviously, as a traditional financial institution, we're sort of caught in the middle a bit. We face both the internal and external challenges in the market, sitting on both sides. If I may share some of our own internal challenges, we've really had to grapple with the management and mindset changes needed to consider crypto products as a viable institutional asset class alongside our traditional products. That's both towards selling towards our clients, but also internally as well. And picking up on some of the more sort of technical points, the Basel Committee proposals for risk capital requirements, the cost there is huge. That's something we need to deal with. Looking at instead of holding physical coins, as Scott Marlier from ISDA noted just on the previous call, we're looking at cash-settled derivatives as an alternative. We really do have to struggle with the lack of regulatory clarity for these products at the moment, and looking at how different products, ETFs, NDFs, and spots and options can be handled in the crypto world. And more importantly, our key challenge is how to de-risk those issues internally. It's not something that we're used to doing at the moment. Looking externally, of course, it comes down to client demand, institutional client demand for crypto products. Is it there yet? What flow is there? Whilst we're seeing an increase in flow, is the demand what would want it to be? That's a big question. Liquidity in the market. Adam noted the liquidity that B2C2 has. We really do need to know that liquidity is there for the coins, and so do our clients. Something I'm also concerned about is the fragmentation or potential fragmentation of regulated and unregulated markets. So there's an awful lot of challenges there for a traditional player stepping into the crypto world. So yeah.
Thank you, Claire. And obviously, Claire, you touched on the conversation around liquidity, capital requirements, obviously being a key issue there. Perhaps, Miles, you can expand upon this from your viewpoint.
Sure. So, I mean, the capital requirements is a massive point that will ultimately shape large parts of the market as they develop in the long term. It was even mentioned by Scott just now in the previous session. So to explain, in 2021, Basel's paper essentially divided crypto assets into two groups. So group one contains stable coins and tokenized assets, tokenized traditional assets, you should say. Those are eligible for treatment under the existing Basel framework, so the tokenized nature of them doesn't really affect their treatment. Group two is pretty much everything else, so everything that doesn't meet the criteria for group one, so Bitcoin and Dogecoin and any other cryptocurrency you can think of, they're all treated the same. It doesn't really matter. Now, those group two assets are subject to a very conservative prudential treatment with the highest risk weight being applied. And what that means is that when a bank holds that group two asset, it has to set aside enough capital to cover the full loss of those holdings. In fact, the full loss of the long or the short position. By contrast, the risk weighting for could be zero for a tokenized sovereign bond. So there's a big difference there. And that would obviously be very capital intensive for group two assets, which affects the bottom line for banks, really. And in many respects, it makes some transactions commercially unviable for them. And we will see that later on. The rationale that was given for that was because the group one assets are really traditional assets, whereas the group two assets are more unique and subject to more unique risks. Primarily, Basel was citing high volatility and unpredictable liquidity. The good thing about Basel's stance is, from a bank perspective, tokenized assets are great, celebrated and even promoted. And even with respect to the group two assets, trading is permitted, as Claire alluded to, I suppose, just now. A lot of financial institutions were really just unsure about this asset class at all and whether they were able to trade in it at all. But Basel's basically saying this is fine so long as you're covered. So that is a plus. And we did see Bitcoin go up, I think, 1.5% after Basel's announcement. So there are some positives there. I also think it's important to keep in mind that when this was announced, there was a great deal of political tension at the time surrounding the Libra project. Now that storm has sort of seemingly passed, there may be some space here to reopen this. Maybe there could be a third bucket. Maybe they could distinguish between, say, more mature assets like Bitcoin versus, others. I won't pick any out, but maybe there's a distinction there. When are the Basel Accords actually going to happen? Well, they don't tend to get implemented very fast. We're usually talking months or more likely years. The one exception was with regulatory margin for OTC derivatives, but the capital requirements tend to move in years, like I said. And as Claire will know, the Basel paper may still have an impact now on capital requirements because the central bank, when they're having their regular discussions and monitoring these, coverage, they could say, look, you're holding loads of Bitcoin. we don't think you're holding enough capital, so you need to hold more in line with the Basel paper. That instruction could come now and may well have done for some.
Keith, do you have any kind of comments to add to this with regards to kind of the challenges you foresee in the marketplace at the moment?
Yeah, so at Covario, we represent institutional buy side. And I would say the capital requirements are not a first order concern for those buy side people. What they are more concerned about is the development of regulation overall. And there we see a bit of a divergence between some of our different buy-side clients. One group very much wants more regulation in the space. These tend to be traditional asset managers who have a mandate to only invest in regulated exchanges. A good example is many US clients who want to invest in overseas venues to trade securities, but cannot do that because those venues are not regulated up to the standards of the US regulators and are therefore prohibited. And so they would like to see more regulation in that space. And I think these people are a lot driven by the empirical evidence on portfolio diversification, showing the benefits of investing in the digital asset class in addition to their other assets that they hold. In addition, very importantly in this space, these people also want regulated custodial services. And I would add that these types of investors mainly trade Bitcoin and ETH at the moment. They're only looking at the most liquid of the tokens. On the other side, we have a lot of clients who I would call crypto native, and they're much more driven by the innovation and the technology that different coins offer. They're very much enamored by new technologies. They want to invest in what could be the layer one protocol of the future, and they want to do relative value trading between different coins. And for them, additional regulation doesn't really serve their purposes, and they're more concerned that given that the likely layer one protocol that will drive CBDC or the eventual tokenization of securities may not even have been invented yet, that too much regulation early on would stifle that innovation because the innovation is likely to come through new token issuance. And if the regulations are too prescriptive, you cannot get that liquidity developed in these new tokens, whether it is on a DeFi platform or an unregulated exchange where it almost certainly will have to start. And then finally, I would add that a number of our clients are very much troubled by the very, very negative real interest rates that they face in traditional finance. And for that reason, the DeFi platforms offer an alternative investment to them where they can get some yields that are above inflation.
Sticking with you, Keith, in terms of risk management and specifically around kind of crypto exchanges and clearing houses versus the more traditional exchanges, perhaps you have some kind of thoughts and perspectives to add on that as well.
Yeah, I mean, this is very interesting. Having spent a lot of time in a previous life worrying about end of the waterfall events at clearing houses and exchanges, which continues to be an issue in that space. It's very interesting that the crypto exchanges, having been able to start afresh and not being burdened by legacy rules, have actually solved that problem already. If you look at all the exchanges in the crypto space, they go straight to variation margin gains, haircutting, if there's an event of default of a clearing member, and therefore the end of waterfall issues go away completely. On the other hand, putting my risk hat on, again, what I don't like in the crypto space is there's still too much of a reliance on wrong way risk in terms of the collateral that the industry accepts. And a lot of exchanges rely on having very fast liquidation engines to solve insolvency or failure to meet margin call issues, when in fact the bigger problem from my perspective is that they have the wrong collateral. So again, it makes it.
Oh, sorry. Thank you. So moving on from that conversation around kind of liquidity and risk, we heard from Scott Emalia before this panel, and given that ISDA are now pushing into the crypto space, perhaps this is an obvious sign that the market's maturing. But also perhaps there's a demand for an institution like ISDA and obviously more standardization around documentation, market processes, etc. Given that a large portion of the market obviously don't meet that ISDA kind of threshold, are there other standards emerging? And perhaps, Adam, this is something you're seeing and you're finding your kind of clients are calling out for.
Yeah, I mean, from B2C2's perspective, I mean, the company itself has always anticipated institutional adoption of crypto. The founder himself came from Goldman Sachs. Most of our senior executives are ex-traditional finance. So actually, the business model really has been to bridge the gap between crypto as it was and the processes and products which make up what we know as traditional finance. So in reality, standardized documentation such as his does, is a natural part of that process. So I mentioned that we set up a CFD business back in 2018. Obviously, we needed to have proper documentation around the margin processes, et cetera. So we did a lot of work with a major legal firm at that time to produce the first crypto ISDA effectively, and that alongside other requirements, such as fixed API pricing, auditable records, proper KYC and AML, enabled the first entry into the market of large professional retail brokers such as GMO in Japan, IG Markets in the UK, and the like. And if I fast forward from that time to now, the big section of the market that we're onboarding right now is tier one investment banks, because they want to do the same thing. They want to trade the price risk without having to settle the trade, because they can't touch the physical. It's as simple as that. So that process of onboarding those clients, incidentally, will involve our parent company SBI, who will act as a credit intermediary. But that caliber of counterparty, has a legal and documentary requirement, which is really a level up from anything we've seen before in crypto. And that's going to further entrench the process of standardization of documentation, in my view.
Thank you, Adam. Miles, Clifford Chance has obviously been involved a lot with ISDA. What's your viewpoint on the role of ISDA and perhaps other developing aspects of this marketplace?
Sure. So, I mean, first, I'd like to echo what Adam has just said. I mean, market participants haven't waited necessarily for ISDA to come along. They have, as a matter of necessity, had to develop their own documentation already to support their trading. And some have done a fantastic job and have some really high quality documentation that actually addresses a lot of the issues that have been correctly identified by ISDA. But one of the big issues, as Scott alluded to, is the need for standardization. Standardization is kind of one of the key foundations that we're looking for here, which will allow the market to kind of take this all to the next level. In terms of the who, well, ISDA is a natural choice, of course. They're the most experienced in running these types of projects, and their success in other aspects of the derivatives market is absolutely plain. The ultimate goal has to be to that crypto assets and this world will eventually become mainstream and will be treated in the same way as other assets. You should be able to be trading your crypto stuff under the same ISDA as your FX and your equities and anything else, right? So that's the ultimate goal. It may be a little way down the road, but this is what we're working towards, and that's why ISDA is very much the right person to be doing that. Now, ISDA's paper won't have an immediate practical impact. It's just to lay that foundation for the working group to, going forward. But there will be quite significant challenges for ISDA in this project. The range of products and personalities is going to be much larger and more.
Oh, I think we've lost Miles there.
Than previous projects. Am I back?
Yes, you're back. Yeah, all good. I think.
Am I back?
Yep.
Okay, good. Okay, sorry. So I was just saying there will be challenges for ISDA. The range of products and personalities is going to be larger and more diverse than previous projects. And also, it isn't going to be possible to differentiate between geographies in the same way that we've done before. Crypto assets don't care about geographical, aspects or timelines. So the output here can't be overly New York or London skewed, but it has to take into account and reflect the trading activity and the conventions that have already been developed in Hong Kong, Singapore, Sydney, Seoul, Switzerland, everywhere really. And the sequencing is actually going to be quite difficult as well. So Scott was alluding to the sequencing, and he highlighted cash settled products. Well, there will be probably quite a polarized demand within the working group for product coverage. Banks will push for cash settled documentation for the reasons that Scott mentioned, partly because of the capital requirements that we spoke about earlier. But other market participants will be very keen to proceed with documentation for physical settlement, because that represents how they're trading today. So that's going to be interesting to see how that plays out. But it's absolutely correct for ISDA to sequence this in a thoughtful way. And of course, the ISDA membership is expanding. For example, we've seen FTX has signed up as an ISDA member, and even Sam is going to be the keynote speaker at the AGM. And yeah, I think it's really important that crypto market players are actually involved in this process, and the arrival of these people in the room and their contribution really shouldn't be underestimated.
Thank you, Miles. I thought it was interesting. Scott was mentioning there was 170 or 180 firms kind of round the table at their digital assets group. So obviously, signed that is obviously playing a kind of a key role there. Keith, do you, obviously with your previous kind of role at ISDA and your current role at Covario, kind of do you have any kind of additional comments to add with regards to kind of the standardization documentation side of things?
Yeah, I mean, another role that ISDA played besides standardization of documentation has been in the SIM, the initial standard initial margin model. And as the crypto market develops an OTC derivatives market, particularly if banks get involved, eventually there will be a pressure to make OTC derivatives on cryptocurrencies also mandatorily marginable. And the question then will be whether you stick that into an existing risk bucket, such as commodities, or whether it becomes its own risk bucket. And there, the risk weightings will have a major impact on the pricing and the ability of banks to be liquidity providers in that space, as well as the implications, again, on the collateral that will be acceptable for those trades. So yeah, I think there's a lot of work, and again, is just probably the best place to resolve some of these issues around OTC derivatives margining.
I want to move on from that and just talk about kind of the regulatory landscape in APAC. And obviously it's ever changing. Indeed, it feels as if we're never too far away from a new announcement being made. We actually have a large contingent of regulators from across the region and beyond kind of joining us today. So I think this is perhaps a good chance for the panel to share some thoughts on this. And perhaps, Claire, you'd like to go first on this.
Yeah, sure. Thank you. Whilst I do sit in London as the seat of the digital asset business for Nomura, we are naturally a Japanese financial institution in our DNA, but we cover a global business. So it's been fascinating to see the global reach of these developments by regulators, and more importantly, it's been really great and very gratifying to see the efforts made specifically by some of the Far Eastern regulators. And I'm going to name, in the developments in Japan, the legal developments in Japan that put some regulatory clarity in for the crypto business quite some years ago, 2019 onwards, has really helped us to frame where our business is going to go. At the same time, Singapore, Hong Kong, really we look to these regulators as being quite developed, certainly market friendly, and we've really appreciated that sort of coming together of the regulatory frameworks in each of those key markets for us in Nomura. Whilst the regulatory frameworks are not yet necessarily aligned with each other, we do appreciate that there is a sort of an Eastern-led regime into moving towards that clarity of legal and regulatory frameworks, which the institutional world does need. I think Keith will probably tell us that Switzerland is probably an exception to that, but certainly the Western markets, the UK, US, we're playing catch up. We're taking that time. It's almost as if we're being led by the Eastern regulators. So Nomura has been very grateful about that clarity being led from some of our key markets. What I would say is we've also had fantastically open dialogue with some of those key regulators, MAS, HKMA, the Japanese Financial Services Authority. And we do see that the regulators are very keen to hear from market participants. They seem to want to know what the market needs, balancing the expectations of both sides of the coin, so to speak. And we really have appreciated that dialogue, both on a bilateral or in a much more sort of market facing role. And that openness of the regulators, specifically in the Far East so far, we welcome that continuation of that dialogue, both on a bilateral and market level. I guess we've heard from several speakers already today on the event so far, and we'll probably continue to have this discussion. But the message certainly from myself is that regulators really do need to balance that sort of need for legal and regulatory clarity with not stifling the innovation this particular market does need, and being able to align those developments going forward with where the market needs to get to. So I think there's certainly an interesting balance coming out of the Far East.
Thank you, Claire. Adam, you're a firm that obviously has a base in Japan, parts of Asia, and the UK and elsewhere as well. Are you seeing a very different approach being taken here in certain parts of Asia compared with the US, UK, Europe, and perhaps even the Middle East?
Yeah, I mean, there's definitely, a sort of regulatory wind, as Claire said, blowing from east to west. But I think there's interesting differences actually within Asia as well. I mean, if you look at Japan, Japan has a long history of selling financial products direct to consumers. And it is also, East Asia, I guess, is the birthplace of crypto. And for a long time, it was purely a retail market. So, it's not really surprising that the JFSA put in place a framework which was focused very much on consumer protection, maximum allowable leverage, et cetera, and customer service and things like that. That contrasts very, strongly with what we're seeing in places like Dubai, possibly Singapore as well, Hong Kong, where, at a high level, government strategy really is trying to gear those locations to becoming hubs for financial services. And in those locations, therefore, what we're seeing is regulatory frameworks being put in place, which are geared much more towards B2B businesses. I think seeing that difference is really important to get the message out there that regulators generally have to understand there's a big difference between running a business which is selling to consumers and running a business which is selling B2B. I think that would be a big positive if regulators take note of that. The other thing I'd like to say is a specific issue with regard to transaction monitoring. Not actually my area of expertise, but I know that we have struggled as a firm to understand what exactly are our responsibilities in this area. I think in traditional finance, I understand it's a lot more clear where responsibilities begin and end. In crypto, not so much. So, for example, on a blockchain, obviously one can see every transaction for a given coin going back to when that coin was originally mined. Is it really our responsibility to monitor all those transactions, even going back 10, 12 years, 30, 40 or 50 hops on the blockchain? That's what we really need to know. And without that guidance from regulators, there's just unnecessary burden on companies like ourselves. So those would be the 2 points I'd like to make. Thanks.
Thank you, Adam. Keith, as Claire mentioned, you're kind of based over in Switzerland. You have some kind of comments on the kind of the East-West and kind of the way that regulators are kind of fostering kind of the crypto markets and such.
Yeah, I appreciate what Claire says about the work of the regulators in Asia. I would just put in a plug that Switzerland has been equally positive and proactive in terms of fostering the development of the industry here. They have what's called Crypto Valley, which is very much a thriving crypto ecosystem in Switzerland. Some of the things I would highlight that are positives for Switzerland, we effectively have an ETF already that trades on exchange here for crypto. It's not called an ETF, but it is economically the same as an ETF. We have very good self-regulatory organizations on the AML side, because AML has been highlighted on a number of panels, is one of the bugbears of the crypto industry, and that's managed very, very effectively in Switzerland. Swiss regulators take a technology neutral view on the assets, so they don't have any prejudices towards one token or another, and that's very important for fostering innovation. And they even allow us to pay our taxes in Bitcoin or ETH.
Wow. Miles, I can see from the background you're based over in Singapore. Kind of what's your kind of take on the work regulators are doing in the region and beyond?
Well, I'll try and be brief. There's a lot we could say here. I mean, look, there's definitely a valuable market that's looking for a home, but with that market comes a high degree of responsibility, and there's definitely significant challenges for any regulator in balancing all of these policy objectives, and we're definitely seeing that playing out in all of the jurisdictions that my fellow panelists have just mentioned. The key points I'd like to make are, I think going forward, we're likely to see regulators being very selective about which aspects of the market they're going to want to actually promote in their jurisdiction. So, for example, tokenization is an obvious yes. Its use case in revolutionizing capital markets is quite compelling, and you can see that in the Basel Accord, for example. So, I'd expect to see a lot of effort on that, but we'll also potentially see quite strong consumer protection moves. Bans on retail investors, etc. That doesn't necessarily mean that a jurisdiction is anti-crypto. It maybe just indicates that they've got a slightly different direction on what they want to cultivate. What's really been interesting as well is the level of coordination and information sharing between regulators internationally when there's enforcement action. So I won't name any names, but very recent examples, there was a high degree of coordination that was evident. I mean, we'll never know for sure, but it must have been coordinated, very similar actions, very similar timing. There's no other real explanation for that. But the policymaker, aside from regulators, the policymakers that are too often overlooked in these discussions about where the market's going are the tax authorities. The tax authorities, relative to regulators, have been very quiet up till now, but we are starting to see the bubbles. They are coming. There's a paper from HMRC that everyone's no doubt very familiar with, talking about capital gains treatment and withholding tax treatment. And even in the US, the IRS have updated the standard income tax form. So there's a line now on income from virtual currencies. So all these are indicators that the tax authorities are going to arrive, and taxation imposes costs, and tax will shape the market just as much as the regulators will on the product side.
Thank you, Miles. Okay, so we have about 10 minutes left of this session. As always, I want to kind of use this to think about kind of where the market is going and kind of to look forward. I think the audience will also be keen to get a sense of where we're going. We've touched on the challenges. We've talked about the regulatory markets, APAC and more, but what do we think we'll see over the next 2 to 3 years? Are we going to see more exchanges opening to institutions to trade on? Are we going to see a burgeoning structured products marketplace? Adam, perhaps you'd like to kind of go first on this.
Yeah, for sure. Yeah. So I think we're going to see two main areas of change. One being where stuff trades, what I call market structure, and one being what trades or product suite. So taking the first, the market structure. I think the main losers over the next couple of years will be the retail exchanges, as they currently are, who are currently doing the vast majority of volume, frankly. And the reason for that is that as the market institutionalizes, for me, institutional traders want to trade in one of two ways. They either want to trade with an OTC market maker, in which case they have a trusted service provider They can make large-scale risk transfers with limited information leakage, and they can have bespoke arrangements around margin finance and settlement operations. Or they want to trade on exchange, in which case their concerns are a high level of connectivity, finance and prime brokerage arrangements, and secondly, minimizing credit risk. Currently, the suite of retail exchanges don't really cut the mustard when it comes to any of those requirements, in my view. So I think what we'll probably see is, as you mentioned, Nick, we'll see what I call institutional grade exchanges growing over the next couple of years and taking quite a lot of market share. And I think we'll just see a general leakage of volume from current retail exchanges to those two buckets, being OTC and then institutional grade exchanges. On the second point, which I see, which is product suite, I think we're just going to see an absolute explosion in the use of derivatives and structured products. Investors are just crying out for ways to diversify how they make money, really. Currently, really, or up till very recently, it's really been, the whole industry's been completely dependent on price appreciation. And after this last run up in price, we've got everybody's coming to us and asking us, like, how can we make ourselves less dependent on price appreciation, make our returns less dependent, and give up some of the upside in return for some enhanced yield. Structured products, index products for risk management purposes, this sort of stuff is going to grow very fast. It's coming from an extremely low, if you look at the number of options that are trading, for example, in crypto relative to the volume of spot, it's an incredibly low level relative to any traditional financial market. So I think we'll probably see growth in the asset class as a whole, and then within that growth, we're going to see a real shift up in that ratio of options and complex products trading.
Thanks, Adam. Claire, some expectations on your side in terms of the next 2 or 3 years.
Yeah, I completely echo what Adam said, actually, about the expected growth of those derivative products. And I think on the institutional side, that's exactly where we would expect and hope the market will go. I think from my point of view, what's very clear is that the regulators are increasingly actively putting in place their own regimes, those frameworks, their decisions, looking at where the US is going to get to, I think will be quite key. But there is no doubt that regulation will increase globally and at local market level. Those that regulatory clarity, which I'm very keen on, will only increase that sort of validity to institutional investors of these products as a really viable asset class in the future. But also to attract new players, institutional players, traditional players to the market for crypto products. That will definitely increase in that more complexity of the products being offered, as Adam's referred to. I think the structured products market is crying out for that money to flow in, and I do see that happening. But it needs to be done in the way that is safe and aligned with where institutional investors are comfortable today. The standardization of ISA documentation, specifically in a digital framework, will definitely help that. Definitely a step in the right direction. And I think that increasing clarity from regulators and markets about what can be traded, what licensing requirements are needed, and how these products can be bundled and sold in the market will also increase. So I think there's the balance between the regulators' activities and the market demand. Expect to see this quite large growth that Adam referred to. Yeah.
Thank you, Claire. Keith, we touched on innovation a little bit earlier. I mean, if you think about it, the role of crypto is obviously meant for kind of decentralization, and we can't obviously ignore the conversation around DeFi. The industry is perhaps forcing a more centralized approach to what is essentially a decentralized technology. Is there a role for institutional participation in the DeFi landscape?
Yeah, I mean, we very clearly see institutional demand on the DeFi side. There are a number of coins that potentially solve problems in the world, whether it is the next layer 1 protocol or whether it's our layer 2 or layer 3 protocol, where the investors want to gain access to those coins, where the only liquidity right now is on DeFi. But they face some regulatory impediments on that. And I'll just give a couple of examples. If a client comes to us and says they want to sell a coin on a particular DeFi protocol, because I have not onboarded that DeFi protocol, and in fact I can't, it makes it very hard to do what's required under the travel rule, because I don't know who the DeFi space is, and I can't onboard them. So I have to turn down transactions where a client specifies what protocol they want to sell on. That's a problem. The second problem, because there's regulatory uncertainty about whether DeFi protocols will be at some point banned, it makes it very difficult to do long-term investments on those protocols. Without mentioning names, it's well known right now that there is one 24-month investment product out there that offers very, very attractive yields. The problem is if you invest in that protocol right now and it subsequently becomes banned, it becomes very, very difficult to get those coins back at the end of 24 months because we would be forbidden from using that protocol. So while I think DeFi is here to stay and is the place of innovation, the lack of regulatory acceptance and does create uncertainties that is inhibiting the growth of that market right now.
Thank you, Keith. Miles, perhaps I'll leave the last kind of comment to you on this. Where do you think, where do you feel transformation is coming from the institutional client space, and at least from the marketplace as well?
Well, for institutions, I mean, it's still very much client demand driven. So, and that will change very much depending on the institution. Those that have large private wealth contingencies are going to definitely feel a lot of pressure for, because those clients want access to trading and exposure to cryptocurrency, for example. So you'll see those types of banks going into that space a little bit more. Others, it's going to be a bit more interesting to see, what direction they take, but there will be something. I think the trend is going to continue of regulatory certainty. It is getting better bit by bit. And I think also the market size will increase. When we get the derivative documentation standardized, I agree with Claire, this will make a big difference. That the amount of trading is going to absolutely explode on that, I think. But once we've got that as the base, we're also going to see an increase in sophistication, because once you've got that and you know that that's okay, you're going to start doing structured products. It may not necessarily be the case that we wait until then, but I think for the mainstream, that's when structured products over these will take off. I think the last thing I'd say is we will start to see a bit more of a split between institutions that will deal with the kind of cryptocurrency space and versus the areas that more traditional banks will deal with. And that will be a split, and I think a large part of that will come down to the fact that the banks will find it very difficult, if not impossible, to compete with those non-traditional providers or traditional provider, I suppose, for this asset class. They're just not going to be able to compete with them. So they are not going to be able to interact quite the way that maybe we'd hope they would be able to. But certainly the position from a Reg Cap perspective is banks are being pushed towards tokenization type efforts. They're being pushed away from the cryptocurrency exchange type area.
Excellent, thank you, Miles. So that's it. We've run out of time. So I'd just like to thank my panelists for a fascinating conversation that, quite frankly, could have probably gone on a lot longer. So Miles, Keith, Adam, Claire, thank you for your time, and thank you all for listening.